Hi, it's Brad with Ocean Consulting Services. I'd like to take a couple minutes to give a quick overview of how the IRS goes about collecting money from you. Let's start at the beginning. Quick example, you've diligently kept your records for the entire year, you've organized them, sent them into your CPA, receive back your tax return, and lo and behold, you have a tax obligation due, a payment due by April 15th. You don't have the money, so you put the tax returns in the kitchen junk drawer, forget about them for a year, and come around to the next year. You're afraid now to file returns because you have a missing return. So whether you have money coming back or owe money, you've decided not to file taxes. And this cycle repeats. It's a common situation that I've encountered and really results in a lot of angst to the taxpayer. So what can you do? How does the tax system work, and what are your alternatives in dealing with situations? So let's start at the beginning. The US has a voluntary, they call it, and I'll put that in quotes, voluntary tax system where they expect taxpayers to prepare their tax returns, file tax returns, and pay any amounts due with the tax returns. So what happens when a return gets filed with a tax obligation owed but no payment? So the tax itself first needs to be assessed. That's a technical term. It means when the IRS processes your tax return and enters the tax obligation that you've determined into their system. So that creates a debt to the IRS. Now, for many people, their withholding or estimated payments are enough to cover the debt, so there's a refund issued and there's no issue. But for others, there is a tax liability owed over and above the withholding or the estimated tax payments. So if there's a payment made, the payment is processed, and the year goes by, no issues for the taxpayer. If there is no payment, now what happens technically, the IRS has a 10-year period to collect the taxes. So that's called your statute of limitations. So their division within the IRS is called the Collections Division. That division is responsible for collecting that tax. So how does that happen? Well, they start off with some friendly reminders. You have an obligation owed to us. Please send us a payment for the full amount. Now, most people who don't pay their taxes by April 15th don't have the funds and therefore don't make a full payment. And those notices go in, again, the junk drawer. Then the IRS steps up their correspondence. They increasingly take a hostile view. You haven't paid your taxes. We intend to take action, and we intend to lien your assets, levy your assets, and take other collection activities. So remember, this is a division within the IRS that has a responsibility for collecting taxes. So they're the bad guys that people deal with and typically have issues with. So let's talk about, there's a couple of different ways to deal with the situation. Two of the main ones that I'll cover today, or in broad detail, is the installment agreement and an offer in compromise. So an installment agreement basically says you have an obligation to the IRS, will allow you to pay it over a period of years. You owe the entire amount, and interest continues to accrue on the obligation, but they give you some time, and while that is going on, there's no further collection activity. So assuming you make your payments, they like you to sign up for electronic payment. As long as those payments are made timely, your obligation, the collection activities cease. So the IRS is not attempting to force collection against you, even though they could, because you have a debt owed to them. The second plan is called an offer in compromise. And what this is the IRS agrees, you and the IRS agree you owe a set amount of money, but you demonstrate to the IRS that you don't have sufficient either assets or future income to pay the liability, so they allow you to actually compromise the debt. It's a very powerful tool. It's one that there are a number of rules around. I'll cover some of the rules in future videos. But for now, simplistically, it's a computation of assets that you have in your available to you, as well as future income potential. So if the IRS determines they cannot collect the entire amount, they may be willing to compromise. Something that a lot of taxpayers don't realize, that the IRS will actually cut money off of what you legitimately owe to them because they want to be paid within this, again, 10-year statute of limitations. The other mechanism by which they attempt to collect, or mechanisms by which they attempt to collect, include liens and levies. Now, two separate things. A lien, it's important to remember with a lien means a say on your assets. So it's similar to your mortgage or a secured loan against your vehicle. So there's specific rights that people have to your assets in the case of non-payment. With the IRS, unfortunately, a blanket lien arises upon, incurring an obligation to the IRS. So when you file your taxes, you don't have enough to pay your taxes, and the debt is assessed. Again, back to that assessment concept. The IRS has an automatic lien in all of your assets. Now, this happens by operation of law. There's no filing requirement. There's no notice requirement. It exists. Now, the issue is that other people who may have an interest in your assets don't know that this is outstanding, this lien against your assets. The most common situation is a taxpayer who owns a home, has some equity in the home, and that's potentially available for the IRS to take to satisfy the liability. So the IRS actually will send you a notice of federal tax lien and will tell you that, in fact, we're putting people on notice that there is a tax lien against you, and therefore, your title to the property is not free and clear, or there's an obligation against it that would need to be satisfied before you could transfer the asset. So that's the most common situation. But remember, even if that notice is not filed, they still have a legal right to any asset that you have a right to. But in order to put other people on notice regarding that obligation, they typically will file something. Again, the most common is a taxpayer who owns a home. There'll be a notice of federal tax lien filed. Now, again, don't panic. If you see this, again, it arises automatically. The IRS will file it. It gets filed with your local land registry, and it's a public document. But it does not mean that the IRS is seizing your home. It just means they have an interest in it, and it certainly complicates things for you. You can't refinance typically, or it's difficult to refinance a home, to sell a home with this lien sitting over it. So again, the IRS can take your property, but that comes later in the process. At the beginning, they just want to establish that you have a debt to them, and they want to put the world on notice that there is a lien against your property. A levy, on the other hand, is a situation where they're actually taking your property. Now, the two typical scenarios are levies against your wages. So they notify your employer that you will have a tax debt, and your employer is legally required to send a portion of your payment of your wages to the IRS. The other involves a one-time levy, and that could be against your bank account. So they could say on a certain date, whatever's in the bank account needs to be seized by the bank and sent to the IRS. Now, these two methods sound fairly draconian, which they are, and they're intended to be severe, but they typically arise when the IRS hears nothing from the taxpayer. They've sent out their notices, they've done all they can to collect, and there's no response. So this is sort of a last resort. And it's certainly something we avoid and can be avoided by working with the IRS. Many people find it surprising that the IRS is willing to work with you. If you've complied with their rules, you have a debt to them, but you can't pay it, they're more than willing to work with you within their parameters. And sort of a prelude, if you will, to filing either an installment agreement or an offer in compromise is that you must be in compliance with your tax obligation. So what does compliance mean? The IRS wants 6 years of tax returns on file, so the most recent tax year going back 6 years, and they want to make sure you're making payments towards your current year obligation, which for most people is, you're having the appropriate withholding done, or you're paying estimated taxes. So that's, I'd say, table stakes to dealing with any issue on collection is they want to make sure they know how much is owed. So they go back 6 years and they want to know that you're currently complying with the tax rules. So many people, again, the people who ignore this for years, come in and their immediate issue is filing back taxes. So we can certainly help with that. It's something we do every day, but it's something to be cognizant of if you intend to try to compromise your debt or get into one of these installment agreements, is that the first thing they check is, are you in compliance? So again, very important to be in compliance. Again, compliance doesn't mean you paid everything. It just means you've filed everything and you've told the IRS, here's what I've determined that I owe in taxes. Now, let's go back to the couple of different methods of paying your obligation, one being an installment agreement, the other being the offer in compromise that I mentioned previously. Under both of these methods, you generally will need to determine income and expenses. So I'll get into further details around what that means in subsequent videos, but for now it's generally cash flow, money coming in versus money going out. How much do you have left over? How much do you have in the way of net value in assets? And the IRS will look at that and say, is there enough equity in your assets plus future income within this 10-year statute that I talked about to collect all that's owed? And if there is, they won't allow you to compromise the tax, but they will allow you to pay it over time. The other situation is you don't have enough to pay over time, and that's when you enter into an offer in compromise where you actually cut the amount of taxes that you owe to the government and pay it either in a lump sum or over a short period of time. Again, I'll get into more details regarding the offer in compromise and installment agreements in later videos. So that's about it for today. Again, important to recognize that both installment agreements and offers in compromise are accommodations by the IRS. You owe the money. The taxpayer owes the money. They should legally pay it. Most people, satisfy their obligation in a timely manner, but there's plenty of situations where people just don't have the funds to satisfy the liability. So you have to remember that they can potentially take dramatic action, liens, levies, force a sale of your house, take a portion of your wages, which is a significant portion, but they don't want to. They would create a PR nightmare for the IRS, which they're already not too popular. So the IRS does have programs specifically set up to try to collect the money over time, or even compromise to say, yes, you owe X, but we'll take a payment of Y, just to move on, to put some finality to a tax year and to fund the government with anything they can. So they're trying to, again, their goal is collection. But they're very willing to work with you, but you need to work within their guidelines. Very, very important to recognize that although some of the rules may sound a little counterintuitive, the IRS takes the view that we're making an accommodation to you, allowing you to spread your payment over time, allowing you to compromise your tax, and therefore you need to comply with our rules. Very specific, and again, in future videos I'll get to this. Thanks for listening.